Jeff Bezos needed money in 2013, not because he was broke, not because Amazon was struggling, but because Jeff Bezos, one of the wealthiest people alive, wanted cash. And instead of selling his Amazon stock to get it, he did something that most people never think to do. He borrowed against it. He took out a loan, a very large loan, secured against shares he already owned. And then he used that loan to fund his life, his investments, his ambitions, without selling a single share, without triggering a single dollar of income tax. You probably paid more in taxes last year than he did that decade. And the reason is not corruption, not loopholes in the illegal sense, not some shadowy offshore account. The reason is a mechanism so elegant, so perfectly constructed, that once you understand it, you will never look at wealth the same way again. It has a name. The wealthy call it buy, borrow, die. And it is completely legal. It is widely used. And it is, depending on how you feel about fairness, either the smartest financial strategy ever devised or the clearest possible evidence that the tax system was built by people who understood exactly how the rich operate. Let's walk through it. First, you need to understand something about how income tax actually works, because most people assume that if you have money, you pay taxes on it. That is how it works for people who earn a salary. You get paid, the government takes its share, you keep the rest. But here is the thing, a salary is income, a rising stock portfolio is not until you sell it. If you own $10 million worth of stock today, and it becomes $20 million tomorrow, you have not earned $20 million in the eyes of the IRS. You have an unrealized gain, a number on a screen. Until you sell those shares, that gain does not exist as taxable income. It just sits there, growing, completely untouched by the income tax system. This is not an accident. It is a feature, one that almost exclusively benefits people who hold large amounts of assets. Now here is where it gets interesting. If you need cash to live, to buy a house, to fund a business, to pay for literally anything, and you sell that stock to get it, you trigger what is called a capital gains tax. You owe the government a percentage of the profit. You have converted an asset into income, and income gets taxed. That is the moment most people assume is unavoidable. But what if you never sold? What if instead of selling, you walked into a bank and said, I have $20 million in stock. I would like to borrow $5 million against it. The bank says yes. Happily, enthusiastically, because if you default, they take your shares. The bank is not taking a risk. The bank is making a guaranteed bet on someone who already has everything. You receive $5 million in cash, in your account, ready to spend. And because a loan is not income, you pay zero income tax on it. Zero. You use that money. You live on it. You fund things with it. And in the meantime, your stock, the collateral sitting at the bank, keeps growing. Sometimes faster than the interest rate on the loan, which means, in many environments, you are effectively paying a small fee to access a fortune you never have to shrink. This is what buy, borrow, die actually means. Buy assets. Borrow against them to fund your life, without triggering taxes. And then die. The dying part is not morbid. It is the most financially strategic part of the entire arrangement. When you die, your assets go to your heirs. And under current United States tax law, those assets receive what is called a stepped-up basis, meaning the cost basis. The original price you paid resets to the current market value at the time of your death. Ever gain accumulated over your lifetime, that entire unrealized gain is wiped clean. Your heirs inherit the assets at their current value, with no capital gains tax ever paid on decades of growth. The loan gets repaid from the estate. The gain disappears, and the cycle begins again for the next generation. You have just watched an entire fortune move from one generation to the next with virtually no income tax applied to it at any point. Now, let's make this concrete, because the abstraction makes it feel distant. and this is not distant at all. In 2021, a report called The Billionaire Bombshell from ProPublica, based on leaked IRS data, revealed that between 2014 and 2018, 25 of the wealthiest Americans in the country paid a combined true tax rate of 3.4%, not on what they earned from work, on the growth of their total wealth. 3.4%. The average American worker pays somewhere between 20 and 30% on their income from a job. People who clean offices, drive trucks, teach children, 3 to 10 times the effective rate of the people whose net worth grew by billions. The system is not broken. It is doing exactly what its structure allows. And here's the part that makes this more than just a story about billionaires, because that is the easy version of this story, and the easy version misses the real mechanism. This is not just something Elon Musk does. It is not limited to people with private jets and yachts. The same basic principle operates at every level of significant wealth. A real estate developer in Chicago does the same thing with property. They buy buildings. The building appreciates. They take out a cash-out refinance, a loan against the equity, tax-free. They use those funds to buy more property. And when they eventually sell, there are depreciation deductions and exchange structures that can delay or minimize the tax even then. A tech founder whose startup just went public has illiquid equity they cannot easily sell without tanking the stock price or triggering massive taxes. So they borrow. They live on borrowed money secured against equity that keeps growing. A portfolio manager who has accumulated substantial positions in index funds does the same thing in a smaller, quieter, less dramatic version. Margin loans, securities-backed lines of credit, borrowing against a brokerage account to fund a home purchase or a business without selling, without paying capital gains, without interrupting the compounding. The people who understand money do not sell assets to live. They borrow against assets to live, and they let the assets keep growing. This is the difference. Not intelligence, not luck, though luck played a role. This specific structural awareness, this understanding that in the financial system, income from labor is taxed aggressively, and wealth from assets can compound almost indefinitely with minimal taxation, as long as you never sell. There is a quiet absurdity buried here that is worth sitting with. The government needs tax revenue. It funds roads, defense, social programs, the entire infrastructure of a functioning state. The primary source of that revenue is income tax, and the primary people paying income tax are people who earn their money through work, people who cannot avoid selling their time, because their time is their only asset. The people with the most money, the people whose wealth would generate the largest tax bills, have constructed a perfectly legal arrangement in which they never need to convert that wealth into taxable income. They access it through debt. They grow it through compounding. They transfer it through death. And at every stage, the tax event is deferred, minimized, or eliminated entirely. This is not illegal. Nobody is going to jail. This is a feature of a tax system that taxes flows of money and largely ignores stores of it. The economist Emanuel Saez and Gabriel Zuckman, who have spent careers studying wealth inequality, have argued for years that the real measure of what someone can spend, what they can do with money, is not their reported income. It is their change in net worth. And when you tax people on income while their net worth grows untaxed, you create a system where the most financially powerful people have the lightest tax burden relative to their actual economic power. That is not a political opinion. That is a mathematical description of the current structure. Now, the question people always ask at this point is, why don't they just fix it? And the answer is that some people are trying. There have been proposals to tax unrealized gains above a certain threshold. There have been proposals for minimum income taxes on billionaires based on total wealth growth rather than reported income. The Biden administration proposed a billionaire minimum income tax that would apply a 20% rate to the total income, including unrealized gains of individuals, worth more than $100 million. None of these have passed. The lobbying opposition to any structural change to capital gains and estate law is extraordinary. The people who benefit most from the current system have both the incentive and the financial resources to fund the political opposition to changing it, which is, if you think about it, its own form of compounding. And on the other side of the debate, there are genuine economic arguments about complexity and enforcement and the potential for wealth to move across borders. Taxing unrealized gains is genuinely difficult to implement without creating perverse incentives or liquidity crises for people who are asset-rich but cash-poor. A farmer who owns land worth $10 million did not become a tax fraud. These are real design problems, but acknowledging the complexity of the solution does not erase the reality of the problem. We have a system where the primary way most people build wealth, going to work and earning a salary, is the most taxed activity in the economy, and the primary way the already wealthy build more wealth, holding appreciating assets, is largely untouched until a sale that sophisticated actors can often avoid indefinitely. The rich do not live on income. They live on loans. They live on borrowed money backed by assets that never stop growing. And the tax bill that theoretically sits on top of all that unrealized gain gets deferred to a generation that will inherit the wealth with a clean slate. The money is there. You can see it. The Forbes list grows every year. The asset values are public, but the income that would generate the tax bill never appears because the income was never created. Just a loan, just another loan, until there is nothing left to tax at all. So the next time someone tells you the system is fair, because everyone pays their share, ask them one question. Which system are they talking about? Because there appear to be two.